Good morning, everyone. Thank you guys very much for joining us today in another one of our education series that we are doing here. Again, my name is Scott Triplett. I am the CEO of U.S. Patriot Title. We are proud to have John King here today. He is an attorney from First American Exchange Company. He is our go-to guru for 1031 exchanges. He does handle all of Florida and did just inform me that he handles all of the East Coast as well. On his first screen here, you will see all of his contact information. We too have all of his contact information at U.S. Patriot Title, so you are more than welcome to contact any of one of our 5 offices as well to discuss anything you want to learn about 1030, not learn, but anything that you want to get in contact with John King about 1031 exchanges. We'll be more than happy to put you in contact with him because he is the one person that we refer all of our 1031 exchange business to. This one today is not for CE hours. It is for viewing, listening, and learning pleasures today. So it's kind of an open forum as well. He doesn't have to stick to a script and do with what Freck states. He can actually go off script here. You can ask questions. Please do use your group chat, unmute yourself and say, excuse me, if you have questions. I'm sure that John's more than happy to take any of your questions and answer them here today. April, I appreciate you putting all of this together for us and helping us with all of our technical needs and marketing needs for this here today. And we will be recording this as well for anybody that wants to look at it a little bit later on our website. Today, we also have present with First American, Linda Rogers is here as well. She is our go-to liaison with First American. And she helps us get all of these classes organized as well with First American and all of our speakers that we've had throughout the years. We're getting ready to put all of our 2021 schedule together. I know that January is coming up quickly and we already have the one scheduled for January. Unfortunately, I hate to say it, but it is a short sale seminar. Unfortunately, I do see that becoming a not a new thing, but a reoccurring thing that's going to happen here momentarily. And although I don't wish them to happen, I do see them possibly coming aboard here momentarily. So we will be teaching everyone again just what is a short sale and how to do them and how to market for them. If you guys have any questions, you're more than welcome to call any of our offices. We have 2 attorneys on staff that are more than happy to answer any of your questions that you have for your real estate title insurance needs. And without further ado, I would like to introduce you guys to John King, an attorney with First American Exchange Company. And he's here to teach you today about tax-deferred exchanges, 1031. John?
Thanks, Scott. I enjoy this type of format because we can, keep it really casual and I can answer any questions you might have. A lot of it I'll probably cover as I scoot through these slides really quickly. And the focus is just kind of on some introductory and basic stuff, at least in this particular presentation because of the time constraint. I don't have my website address up there, but it's firstexchange.com. Ton of information out on that website, brochures, informational pieces, etc. And you are welcome to check that website out at any time and grab any of that information. We're set up to be, I like to call us a free consulting service in the hopes of capturing exchange business. And what that means is anyone, you included, or your customer or the like, can call that toll-free number. And we use that just for convenience sakes. We do have some local numbers that are 904 numbers because my office is actually down here in St. Augustine. But you can initially use that toll-free number, and anybody that answers the phone can answer about 99% of the questions that come into us from individuals. But again, you are welcome, your customers are welcome, their advisors are welcome to call us and ask us any question that they have related to 1031, and we will answer them. And hopefully, put them on the path to doing a 1031 exchange, at which point we would hope to act as their qualified intermediary, and we would charge them a fee at that point. But until we get to that point, everything we do is just for free, essentially. And Scott mentioned he's got a couple of attorneys working for him. And the one thing I always find amusing is that I'm probably one of the only lawyers you can talk to as much as you want for free. So that's always a good thing.
You can
But I do
talk to
have a
both
couple
of our
other.
attorneys. You can talk to both of our attorneys as much as you want. It costs
That's
me,
awesome.
not them though.
So I have a couple other lawyers that work with me and a couple paralegals. So, we're pretty adept at this process. I myself have been doing exchanges since 1996. So not much that you could put in front of me that I wouldn't be able to communicate about. The one thing I like to tell real estate people in general, why is this important to them? A couple of reasons. One is recognizing when you should or could talk about this, or at least alert a customer. And that is anytime someone is selling a non-owner occupied piece of real estate, and that could be a single family residence, a duplex, triplex, commercial, you name it. It could also include land. Anytime that type of asset's being sold and it's non-owner occupied, they ought to at least inquire about the benefit of 1031 if it's available to them and if it makes sense. So I alert you to that. And the other reason I think it's important is, if you know a little bit about 1031, because I know you're not required to, I think there's one paragraph in the review course for licensing here in Florida. If you know a little bit about it, you can distinguish yourself from your competition when you're looking for listings and the like. And then the other nice thing about it is we have a short window of opportunity, which we'll talk about in a couple of slides. And what that means to you is if you have a customer that's buying and selling in the same general area in which you can practice, you can get 2 commissions in a quick period of time instead of just 1. So I think that's an interesting thing to keep in the back of your mind, that not only can it benefit your customer, but it can benefit you as well, depending on where they're looking to purchase. So with that said, I'll give you a little bit of information about 1031 in general and kind of what the process is and how we transact and what other interesting tidbits might be available for you to keep in mind. So this first little slide here, this is the actual paragraph from the Internal Revenue Service. And it basically just says, no gain or loss is recognized on the exchange of real property held for productive use in a trade or business or for investment. I don't know, how many of you might touch commercial real estate in addition to residential, but this trade or business one comes up a lot with professionals that are retiring a lot of times. So veterinarians, dentists, lawyers, title company owners, real estate company owners that are retiring and are looking to sell the building that they operate their business out of. That transaction might qualify for 1031. So that's a trade or business asset that we look at quite frequently. And then investment means just that, something that you bought, you're hoping to see appreciation on it. Doesn't necessarily have to be income producing, just held for investment. And so if you exchange something of that type for something else of that type, you can get tax deferred treatment under Section 1031. And it is just that, it's a tax deferral tool. One of the things that aggravates me a lot, especially during the last or this recent political cycle, is when there's talk about 1031, people call it a loophole, or they call it a tax avoidance scheme, or other really derogatory things, which that in fact is not what it is. It's simply a tool that allows you to defer, and you can defer indefinitely. And the deferral tool actually helps you determine when you might want to recognize the tax, because it might make sense at a particular time to cash out and pay. But it's simply that, it just helps you defer. And most people are doing these transactions for that purpose. They just want to delay the recognition of the capital gains tax that would occur if they were to sell an investment property. So, what do you do here with 1031? What you're typically doing is selling property and buying similar property. And what we mean by that is similar simply means investment or trade or business. Because you can buy and sell any type of real estate that's held for investment or trade or business and exchange it for any other type of real estate that's held for the same purpose. Again, delaying the payment of the capital gains 1031's been around a long time, since 1921. We've had some changes over the year, but we really don't change significantly over time. Sometimes they'll, the most recent change we had is in 2017, they did away with personal property transactions. You may or may not have known those even existed, but we did away with those. And as a result of that, they had to codify a definition related to real estate, which they recently did. So that's the most recent change for us as an industry, and not very significant, because they basically just made it more clear that the definition we've always used is exactly the definition that should be used. And it's a federal law. Oftentimes, most states follow it to the letter. The only deviation typically is there's a couple of states that, if I'm a Floridian, for example, and I own a piece of property in their state, and I'm selling that piece of property as a non-resident, they'll want to try to collect some tax from me. But typically, there's an exemption process available. You file the appropriate paperwork, and then you can get deferral on the entire transaction. Especially here, you probably have a lot of customers that come from out of the state, a lot from New York, for example, and other northeastern states. And they typically have state income tax and borough income taxes and perhaps city taxes that are associated with dispositions. And so typically, though, if they structure their transaction as a 1031, they can defer those taxes as well. So what's the requirement? It's pretty straightforward. You need to acquire like-kind real property. And again, for us, it's a very broad definition. Like-kind simply means real estate that's going to be held for investment or used in the trade or business. So I can exchange out of a single family rental into a commercial strip center. I could exchange out of land into a duplex, as long as it's real estate for real estate. And then we have a definitive timeline. And I'll put up a little visual of that in a couple of slides. But effectively, we have a 180-day window in which to transact these sales. And it's broken up into two parts. The first 45 days is the identification period, and we can go into a little bit more detail about that in a second. And then you've got the balance of 135 days for that total 180 window to actually close on something that you identified within the first 45 days. And then one of the other things we have to pay attention to is we have a same taxpayer rule in 1031. And what that means is whatever taxpayer sells is the taxpayer that should be making the acquisition. And it gets a little quirky sometimes. Here in Florida, for example, since we're a separate property state and not a community property state, if a husband sells, technically the husband is supposed to buy by himself. And oftentimes we have situations where a husband might have an asset that he had pre-marriage that he's now selling. And their intent is to buy it as husband and wife because it's now going to be a marital asset. But we have to pay attention to that because of the same taxpayer rule. Because 1031 is a little different than other tax code sections where they treat a husband and wife as one person. We don't do that with Section 1031. So when we see that, though, we'll alert everybody and we'll make sure that they are doing it correctly. And there's a workaround, and we would make sure that that's done to effectively allow the spouses to purchase together. Another one that comes up quite frequently is limited liability companies, for example. Oftentimes people, specifically husband and wives, when they have a LLC, they think it's just a disregarded entity because they file jointly. Unfortunately, that's not the case here. Again, in Florida, for example, that's really a partnership. If you've got more than two people in an LLC, it doesn't matter if they're married. That's a partnership for tax purposes. So we need to pay attention to who's selling and who's going to acquire to make sure we keep that same taxpayer requirement consistent.
Excuse
me, and then
John.
The main thing, yeah, go ahead.
If say the husband's doing a like-kind exchange, but he now wants to put it into a trust where he's the sole beneficiary trustee, can he do that? Is that still considered same entity?
Yes, because a trust, a revocable trust, presumptively, that's a disregarded pass-through entity. So that would be okay because it's going to roll back to the same taxpayer ultimately.
Okay.
It's a good question because oftentimes we have trusts that are selling, and if they're borrowing money on their acquisition, banks don't like to lend to trusts, and mortgage brokers don't like to lend to trusts. So what we end up doing is have the trust sell, and then the individual grantor and trustee acquire, and then post-exchange just contribute back to the trust. So that does come up quite frequently. And then the key thing is, in order to make these transactions valid, you've got to go through the qualified intermediary process. And the reason it exists, there's a couple of things that the IRS is looking for taxpayers to avoid, but the main reason it exists is because we're considered a neutral. And as a neutral, we can set the transaction up and make it compliant with the regulation without there being any unintended consequence of using someone who might be deemed your agent to help accomplish this task. And that's the whole reason the qualified intermediary business exists. So let's do a look a little bit at exchanges. This comes up all the time. And I spend my entire day fielding phone calls and answering these types of questions, this one in particular. So what do you have to do to get tax deferred treatment? And most people, when they contact me, are looking to get 100% deferral. It's okay if that's not the desired outcome, but most of the time, that's what the initial conversation is about. I want to get rid of this asset and I don't want to pay any tax. So what do I need to do when I go to make my purchase to make sure that is what the result is? And so we use a little thumbnail test. And so for me, it's pretty straightforward and easy. If you want 100% deferral, you're looking to acquire something that's of equal or greater value than what you sold. You want to make sure that you spend all of the net proceeds that are received at the closing of the sale on replacement property. And if you've paid off a mortgage at the closing of your sale property, you need to replace that mortgage on your acquisition piece with either debt that's of equal or greater value to the mortgage you paid off, or by putting your own cash in to offset that mortgage that was paid off. And the reason those are the requirements is, if you see this no boot little comment here on this slide, in 1031, whenever you sell something, you receive boot. And if it's a mortgaged property, you receive cash boot and you receive mortgage boot. And the whole idea is, if you receive boot, you want to pay boot, and those items completely offset. So here's a numerical way to look at it. So let's say I'm selling a piece of property worth $2 million, and it's got $1 million worth of debt on it. That means, and we're going to ignore closing costs for the moment, that means I'm going to net out $1 million of cash. And so when I'm looking for replacement property, if I keep my little thumbnail test in the back of my mind, the first thing I know is I want to go equal or greater in value. And here I'm going to buy something for $2.5 million. So I've satisfied that prong. I'm going to spend the $1 million as a down payment on that $2.5 million asset. So I know I've spent all my net proceeds. And because I need to finance at least $1 million, in this case more than $1 million, I've now completely offset that mortgage boot that I received as well. So in this particular transaction, this would be 100% deferred 1031 exchange transaction. And that's the goal of most people, as I mentioned. However, you don't have to get 100% deferral to have a valid 1031 exchange. Oftentimes, my customers want to take cash at close. And as long as they're okay with paying tax on the cash that they take, perfectly fine. Or sometimes their intention is to get 100% deferral, but for whatever reason, it ends up that they can't satisfy one prong or another. So in this example, sell for $2 million, pay off a mortgage of 1.4, end up with 600,000 of cash at close. Here they're going to buy for 1.8 million. So we know immediately that there's going to be an issue, and because they have not purchased equal or greater in value. So then we look to see what the balance looks like. So they're going to spend all the cash, so we know we're okay there. But because they went down in value, they're having to decrease their debt load by 200,000. And so in that example, that would be $200,000 of mortgage boot that would be taxable. And this is a scenario that actually drives people crazy because they're like, hey, I didn't get any money. Why am I paying tax on money that I did not receive? And the unfortunate circumstance in 1031 is that you always have to be concerned about the mortgage. You don't get to just ignore it or walk away from it. And then another common question that comes up is, I gave you the thumbnail test, but oftentimes people think that I just have to reinvest my profit. And unfortunately, that is not the case. You've got to satisfy those three prongs of equal, greater in value, spend cash, replace debt. You don't get to keep anything. You don't get to back out your basis. You don't get to recoup any improvement expenses that you necessarily incurred. You're just looking at the totality of the transaction. And for me, it boils down to this. Whatever I sell for, that's what I'm looking to purchase for. Otherwise, I'm going to have some taxability.
Hey, John.
Yep.
Christina has a question for you as well. Christina, can you unmute yourself? Did John answer your question already, or do you still have the question about can the transaction happen in reverse, buy first, then sell, and qualify for 1031?
Right. Does that make sense? Like, for instance, an investor has a rental property and they want to buy a different rental property and move their tenant into that one and get rid of one that they originally have.
Mm-hmm.
Can they buy it first and then sell the other one and it counts as a 1031, or it should be in that order?
No, you can do it in reverse, but it's a more complex and expensive undertaking.
Okay.
And the reason being is the IRS does not allow you to own both pieces at the same time and call that an exchange.
Okay.
So what happens is I refer to them often as a parking arrangement, because what you have to do is when you do a reverse exchange, you have two things going on at the same time. You've got the actual exchange that's going to take place once the sale occurs, but you've got that interim parking arrangement. And so we use a vehicle called an exchange accommodation title holder, or EAT. That's the acronym. And essentially what the taxpayer does is they say, EAT, I would like you to acquire this piece of property for me, and then I'm going to put my other piece on the market and hope to get that sold within 180 days of when the EAT took title to the parked property. And presuming I can make that happen, that works as a good structure. Now, the issue becomes you haven't sold anything, so how are you funding that purchase? If it's a residential investment property and you're intending to borrow money from a mortgage company or a bank, the likelihood is you're not going to be able to do it because that EAT is always a single member limited liability company, and banks, mortgage companies on residential transactions don't lend to LLCs because it makes the mortgage itself unsaleable on the resale market. And unless they're going to service the loan, they're not going to work with us on the LLC. If it's commercial or if it's a private lender that wants to understand the process, we can make it work, no problem. So that's issue one. And then what you're really doing now is you're asked, and we typically act as the EAT, and then we act as the QI when we do the exchange. Now you're asking me to get into the chain of title on a transaction that I normally wouldn't have to. And so as a result, we charge more.
Okay.
So as an example, on a basic residential reverse exchange, that's probably going to run around $5,500 to $6,000 versus a standard forward exchange where you sold first and then bought that asset. You're looking at like $1,000 of a fee. So
Okay.
Big difference in the pricing and a big difference in how we structure. But we do lots of reverse exchanges. In fact, yesterday was my day from hell on reverse exchanges because every call from the time I answered the phone until I went home was about a reverse exchange. And about 8 out of 10 times they don't work. But for that 2 times that they do, we do quite a lot of them on a monthly basis. So yes, you can do them. You can also do that in the form of a reverse improvement exchange. So if you wanted to park and make improvements, you could do that as well. And then you can also do what's called an improvement exchange, which is you sell first, you have the EAT acquire that target property, and that EAT makes improvements to it with your exchange money. And then sometime before 180 days expires, the EAT will deliver the improved property to the customer. Again, that the reverse improvement and that just forward improvement exchange transaction They all involve parking, and therefore they're all a little bit more expensive. But it is a valid option, and there's oftentimes when that's the best route for customers. I do a lot of them for customers who operate their businesses out of warehouses and the like, and they're looking to get bigger space, and they can't have business interruption. So they want to take down their new piece, move into it, and then they'll sell their other piece after they vacate. So that's reverse is a popular tool in that particular scenario.
Okay.
So reasons why people exchange, I mentioned the main one is, get tax deferred treatment. But there's many other reasons why people do these. And so this is just a list of some, not a comprehensive list, but some of the most common ones. So perhaps you bought something, 25 years ago, and you fully depreciated at this point, so you're not getting any tax benefit from the ownership other than cash flow. Perhaps you want to get out of it, buy something that's of more value, and restore some depreciation deductions for that increased value. Got co-owner problems. Let's say you and your buddy bought a piece of property together and all was fine, and then you have a big blowout and can't stand each other at this point. How are you going to extricate yourself from one another? 1031 might be an option. You're tired of the 4 T's, the tenants, toilets, trash, and taxes. You want to get out of something that might be management intensive into something that might be like a net lease transaction that just cash flows. So that's a rationale that people articulate to me all the time. Relocation. I know, Jacksonville being a large military area, oftentimes people buy a small rental when they're stationed somewhere, and then they get restationed elsewhere, and it doesn't make sense to try to manage it remotely, so they'll exchange from their old duty station to their new duty station. Leveraging tax deferral benefits. So oftentimes I have customers who are really equity rich on their current property, and they don't want to refi it necessarily. So they'll sell it and buy something that will support a much higher debt ratio. And they'll do their exchange, and post-exchange immediately refi and get access to all their equity tax deferred. So that's sometimes a rationale. Improving cash flow. Let's say you own a piece of dirt that's not cash flowing, and you want to exchange it for something that is income producing. That's a reason to do it as well. Diversify or consolidate. If you own one big one and you'd rather have several smaller ones, you can do that via an exchange. If you have several smaller ones and you'd rather have it in one big one, you can do it that way too. And then estate planning. I'll give the example of I have 3 children. And if I had a piece of real estate that I wouldn't necessarily want to leave to the 3 of them, I could exchange out of that piece, perhaps buy 3 smaller ones as part of my exchange, and then I could leave each of them their own property as part of my estate planning. And then again, I mentioned the debt one. That's a popular one at the moment because of the appreciation we've seen, because of the tightness of inventory in the real estate market. So people are acquiring property that supports a higher debt load in order to get access to some equity. So, again, deferral is the primary one because it's all about the taxes, just like this slide says. And so whenever anybody talks to me about a possible 1031, one of the things we want to talk about is, what's your tax bill? Because there's a couple of things that you need to look at before you just say, I'm going to do an exchange. So right now you see if you sell something and it's subject to short-term capital gains, that's just your ordinary tax rate, whatever that is. Long-term is if you own something for a year and a day, you convert from short-term to long-term. So right now, if you're an individual and you earn less than $418,400, or a married couple earning less than $470,000, you're in a 15% capital gains tax bracket. We'll talk about the depreciation one in just a second. If your income is above those 2 thresholds, then you're in the 20% bracket. Now, there's been a lot of rhetoric about 1031 as part of the election cycle and the changing of not only of 1031 process, but also of capital gains rates. So that's something that people need to pay attention to when they're doing an analysis of sell or exchange, because we're not quite sure where those rates are going to go and who's going to have the ability to continue to do 1031 exchange. My
Excuse
hope
me,
is
John.
that, yeah, go ahead.
We have another question when you
Huh?
get a moment to get to it. It's
No, and
the exchange.
I'm
do
glad
the
you're interrupting
exchanges,
because I can't see,
okay,
I'm not seeing the chat window for some reason.
okay. Do the properties you exchange have to be in the same state to qualify? And if
No.
I misrepresented your question, please feel free to unmute yourself and ask directly.
Yeah, if that's the question, the answer is no. You can exchange property anywhere in the U.S. for property anywhere else in the U.S. There is an exception for Guam and the U.S. Virgin Islands and the Mariana Islands for whatever reason, where you can do exchanges from there to mainland U.S. Interestingly enough, Puerto Rico is not included in that exception, which doesn't make any sense to me. So I think, there's a lot of talk about statehood again and the like for Puerto Rico. If you could exchange properties here for properties there and vice versa, I think that would be a huge boon for the real estate market just in general. Having spent some time in Puerto Rico, it's a fantastically beautiful place. It'd be nice if you could exchange a beach place here for a beach place there, because it's still pretty pristine there. So that's what you're looking at in the way of taxes. That's just from a federal standpoint. If you live in a state that has state income tax, you also have to factor that into your analysis as well. And then additionally, if you are an individual or married couple with gross income of 200 and 250 respectively, you have an additional 3.8% tax that you're responsible for that goes towards Medicare and Medicaid. So the tax bill can be fairly significant. So this is a little slide about how one might go about doing an analysis of what the tax might be. So I've been doing this for so long. When people throw out a number to me, meaning a sales price, it often prompts me to ask them some questions about their to be sold property to get an understanding of what the basis might be. And the reason you want to know the basis is because the difference between the basis and the sales price is what you're going to pay tax on. So it's important to know that. And I'll give you an easy example. I do transactions all across the spectrum. And so I have one that's going to happen in January. That's $225 million sale. I have one that I just opened today. That's a $60,000 sale. And so that $60,000 one is the one that really prompts me usually, because I want to ask, how much gain do you have associated with this transaction? Because $60,000 doesn't seem like a big number, but in that particular one, that taxpayer's basis is $5,000 in that piece of property. So he's got $55,000 of gain that he would have to pay tax on, and he's from a different state. So his combined tax on that small transaction is close to $10,000. And so he'd rather do an exchange and defer that 10 instead of write the government tax collectors $10,000. And so it's not dependent on sales price. It's really dependent on basis. So here's an example of, assume for a moment I bought a piece of property back in the day for $100,000. Over the years, I've depreciated it by $50,000. So my adjusted basis in that property is now $50,000. If a buyer comes along and says, hey, I want to buy your piece of property for $800, I now know that the difference between my adjusted basis of 50 and my sale price of 800 is what I'm potentially going to pay tax on. And then I just need to break it down into the categories. So on the previous slide, you saw the depreciation recapture rate of 25%. So the first 50,000 of my gain is going to be taxed at 25%. The balance of that 700,000 of gain is going to be taxed at whatever my capital gains rate is. And in this example, we're assuming that the income of the parties is in that 15% tax bracket rate. So in this example, just from a federal standpoint, they'd have to pay $117,500 in taxes. And then if they're coming from a state that has state income tax, add on to that. Example, California, they're trying to raise the income rate or capital gain rate to 13% on a sale of this nature. So add in another 13%. So there's a lot more analysis that has to be made if you're coming from a state with state income tax. So in this example, most people would say, unless they have a reason to, why am I paying over this huge sum of my appreciation in this real estate asset to the government? And they would probably structure this as an exchange. So some myths, I think these are important to keep in mind. Exchangers have to find someone with property to swap with. That is not the case. You can sell to a third party and then buy from some other party, and that can be structured as a tax-deferred exchange. No reason to already have it set up ahead of time. I think the reason that rumor still persists is that's how it was back in the 20s, because it was really designed for farmers to exchange farm property for other farm property. And so most of the time, farmer A wanted what farmer B had, and farmer B wanted what farmer A had, and they would just swap. But you don't have to do that anymore. You have to buy the same type of investment real estate. Again, no. As long as it's real estate and as long as it's going to be used for investment or trade or business, it qualifies. You have to complete these things simultaneously, meaning, on the same day, and that's not true. That's why we have that 180-day timeline. And at the end, I'll show you a little slide of how these transactions actually progress in the process. And you can see they can be done that way. In fact, I have one that's going to be done that way next week. But typically, they're done on a delayed fashion, sometime on that timeline.
Excuse me, John.
Exchanges. Yep.
We have another question. If you have to pay the capital gains tax eventually, what is the point of the deferring?
So I'll give you an example, and this is a real life one that I was speaking with somebody yesterday. So there's a couple that would like to sell a piece of real estate, and what they want to do is acquire real estate from her father, and that has its own issues associated with it. But let's just assume for a moment that they can do that. If dad sells to daughter, he has to write a huge check based on the gain that's built into that transaction to the government. And so in that example, what they would like to do is they don't want dad to write a huge check because he's older and he has no income at this point. And so rather than just throw all that money away, they want to do something that allows for him to put that tax off for a period of time and get cash flow. So we're working on a structure for that. So typically, that's the kind of the analysis that you have to undertake. Yes, you're only getting a deferral, but candidly, under today's regimen, there are ways to get out of that tax. The first one, not so popular, you have to die. That's not a good thing. But if you die while you still own property that you've deferred taxes on, those assets pass to your heirs, they get a stepped up basis, and there's no tax due. So you can eliminate it altogether that way. There's another way where you can maybe eliminate it all the way, but certainly diminish it. And that would be if you exchanged into something that you then converted to your primary use down the road, moved into it, and then satisfied the requirements of Section 121, and then try to get the exemption, 250 if you're single, 500 if you're married. And depending on how long you've used it for each particular purpose, you're going to get some elimination of some of the gain. Or you might also think, I want to defer it now because I've got a bunch of income, and therefore I'm going to pay a higher rate based on my income, versus if I wait to sell it to when I'm in a better cap gain situation from a rate standpoint, that's when I'll cash out. So those are all the things that need to be thought about when you're considering exchange and defer, or just sell and recognize. And then also another thing might be, let's say you have one big one and you exchange it into three smaller ones. Well, then you could decide when you're going to liquidate. So let's say you go, you know what, in 2 years, I'm going to liquidate property A and I'll pay a third of the tax then. And then a couple of years later, I'm going to liquidate property B and I'll pay a third of the tax then. So you can pick and choose when you actually pay based on when it is most beneficial for you. And that's one of the reasons. But, you do have the choice. If you say, you know what, I'm tired of this game. I'm just going to sell and pay my tax and move on. Perfectly acceptable. But if you're looking to manage your tax bill over time, the deferral process is the best way to do that at this point.
Excuse me, John,
Um,
you just mentioned
Yep.
you just mentioned property A switching to property A, B, and C. So that means that
Uh-huh.
you can use your deferred money to purchase more than one property?
Correct. You can diversify in 1031. And I'll use myself as an example. I had a rental property that my wife cajoled me into, and it was fairly expensive. And it worked out fine in the end run, but looking back at it now, I would have preferred, instead of buying the one larger one, that we had bought several smaller ones, just because then if there's a problem, your all your eggs are not in one basket. And so a lot of people do diversify using 1031 so they can spread their risk out over multiple properties instead of having all of their eggs in one basket. So yes, you can diversify, and then you can consolidate. If you say, 3 is too much to manage, I only want to manage one, sell all 3, move all that money into the larger one, and it works that way too.
And all those properties have to be identified in the initial period as well?
Correct.
Okay.
Correct. So it always comes down to timing. We want to ensure that whatever you're trying to do, there's going to be a sufficient amount of time to make that happen. Exchanges are expensive, difficult, and only for large properties. I think you can tell from some of the comments I've made already that's not true. They're not very expensive if you're doing them in a forward fashion. They are not difficult at all. If you hire someone as a QI that's knowledgeable and knows what they're doing, it's virtually transparent to you as a realtor, to the title company, because there's only a couple items that they have to be concerned with. And it's completely, essentially transparent to the buyer or seller, depending on which side you're on the transaction. Exchanges increase audit exposure, not true. Mostly not true. If you do a partnership transaction, you've got to tell the Internal Revenue Service that you did that. And if you do a related party transaction, you have to tell the Internal Revenue Service that you did that. So because you tell them those 2 items, that might increase your audit risk. But if you're just doing a normal standard exchange, it doesn't increase audit risk at all. If you live on part of your property, you can't do an exchange. Not true. If you have a duplex, for example, and you live in one unit and rent out the other unit, you could structure that as a exchange on the unit that you rent out. Not a problem. Exchangers don't need to hire a QI. They can simply have their attorney hold the exchange funds. Most of the time, that is not an accurate statement. What the IRS is looking at in a QI is they want them to be a non-disqualified party. So what that means is if you're a disqualified party, you can't be QI. Most people are disqualified if they've had any kind of relationship unrelated to the exchange in the 2 years prior to the sale of the relinquished property. So if you have an attorney, for example, and that attorney helps you, with your various and sundry activities, and then you decide to sell something and you say, hey, lawyer, I want you to act as my QI. In that example, they would not be able to because they'd be a disqualified party. Exchangers can just call a transaction an exchange and self-report. Unfortunately, again, not true. You have to go through the QI process in order to have a valid exchange. And I'll give you another real life one. I had somebody from Atlanta call me yesterday saying, hey, John, I closed yesterday. Can I set this thing up as an exchange? And unfortunately, because of what they had done, the answer was no. And so the next logical question is, okay, well, can I just report this then? And the answer is you can do whatever you want as a taxpayer, but the likelihood is you're not going to be successful because that's not the way you're supposed to do exchange transactions. So if you get audited, that's going to be a problem. And unfortunately, that happens more often than not with people not realizing they have the opportunity and then going ahead and closing and then having the epiphany that, ooh, I should have structured this as an exchange. So one of the things I hope that anybody I talk to in this format, telephone, email, makes no difference, is that it helps them help their customer recognize that the opportunity exists before they go ahead and get to the closing table and close. Because once you do that, we can't help, unfortunately. Sorry, I was trying to see my clock to see where we were, and my eyesight's getting worse as I get old, so I had to squint at my phone to see what it was. So again, what qualifies property held for investment or use in a productive trade or business? So what doesn't? Your primary residence doesn't qualify. That's going to be handled under Section 121. Stocks, bonds, notes, anything traded on the stock exchanges, NASDAQ, New York Stock Exchange, et cetera, not going to qualify. An interest in a partnership or an LLC, that interest, which is equivalent to a share, let's call it, that's not exchangeable. But that doesn't mean that a partnership that owns real estate can't exchange that real estate. They can. A partnership can exchange real estate just like anybody else. And the same with an LLC. If an LLC owns real estate, it can exchange real estate just like anybody else, just not the underlying partnership interest or membership interests. Inventory, dealer property. So people that like to buy, flip, and buy, fix, flip. If that's where the bulk of their income is coming from, they're not supposed to be doing 1031 exchanges because what they're doing is holding for inventory, resale, not holding for investment. And their hold periods are typically very short, and they're just moving on property. So the easy answer is you shouldn't be doing 1031 exchange. The better answer probably is it's not an absolute preclusion, but we really need to look at the facts and circumstances before you go ahead and just set it up as an exchange.
Excuse me, John.
And then
we have a question about vacation home. Is that a possibility?
So the answer is yes. And then you have to do an analysis of, are you in what we call a safe harbor for that, or are you outside the safe harbor? And you can choose to do it either way, but if you're inside the safe harbor, you're basically doing an analysis of your personal use of that asset. And right now it basically says, if you use the asset 2 weeks or less, or less than 10% of the overall rental period of the asset, it's okay to have that treated as an investment property. So if, let's say I had a rental, a vacation property, and I rented it out for 300 days of the year, then I could use that as a vacation property for myself for 30 days, and I could still classify that thing as an investment property and do a 1031. If you're outside of those restrictions, use limit restrictions, then you just have to do an analysis and look at your actual use and say, am I comfortable that if I got audited, if I did an exchange and got audited, that I'd be able to substantiate to the service that even though I might have had what appears to be a little bit excess use, that it still was a rental for the most part for me. So again, convoluted a little bit, I know, but not an unequivocal no. We got to look at facts and circumstances, or look to the safe harbor to see if you're inside those restrictions. And if you are, then you know you can do it. A little bit about QIs. We're an unregulated industry. Most people don't know that. So what I suggest when you are looking for somebody is you'd like to see an entity, like a corporation or an LLC. That is the QI. You'd like to know if it has any kind of financial strength to it. Is it offering up any protection in the form of insurance or a bond coverage to the customer? Is it a member of the only trade organization that exists for our business, which is the Federation of Exchange Accommodators? And I would tell you that for the most part, the most reputable and the ones that offer the most protection are title insurance related exchange qualified intermediary companies. Again, because we have large parents and they're concerned about liability, not only for them, but for the company and the shareholders. And so typically those types of entities, which is what we are, we have a lot of protections in place for the customer, including how we handle their money when we take possession. Why is it important? Because a lot of people shop for this product solely on price, not on expertise or protection. And I'm going to give you one quick example, and it happened right in Jacksonville. A gentleman was running a QI company in an LLC of which he was the sole member. And one day they found him at a railroad crossing on fire in his vehicle. And so he was sent to Gainesville and he was put in a coma, and he had a bunch of exchange customers who needed things done. And because he was the sole member and had no other employees, nobody could do anything. No transactions could be done. No money's moved. Nothing could be accomplished in these exchanges. That was bad enough. And then it turned out this particular individual was really doing stuff he shouldn't have been doing with exchange money. He was using it for purposes other than tax-deferred exchange transactions. And so they had to appoint a receiver. And when the receiver came in, they discovered that lots of exchanger money was missing. So there we've got 2 strikes. The third strike is because he's a little mom and pop independent and offered no protection because he didn't have to, no insurance, no bond. So these poor people are out their money and still have to pay their tax and probably will never recover anything. So that's a bad horror story. Unfortunately, it happens from time to time. So I just suggest that customers vet their potential QI and make sure that there is protection for them. How's the money being handled? Are you bonded or insured? And how are you going to make sure that if I give you money, I'm going to get it back? Those are important questions. What do we do, though, as a business? We prepare all the documentation related to the exchange transaction. We instruct all the parties involved, settlement agent, et cetera, how their files need to be amended in order to reflect that an exchange is taking place. And then one of the more important things to do is we hold proceeds. So in every exchange, this is why you have to be you can't be a disqualified party. In every exchange, the QI is holding money. That's to avoid actual or constructive receipt of the money by the taxpayer. And so essentially, the customer is giving us their money. It now is legally our money, and we can do whatever it is we choose with it. What we do is set it up in a for the benefit of account so that our banking partner can separately identify those funds to our customer so that in the event, for example, we were to file bankruptcy, that money would not be tied up in our bankruptcy filing. So the customer always knows where the money is, and the customer can always get it back if something happens to us as a QI. And then the other luxury that we provide is we get to do what's called direct deeding. So I mentioned previously, we're never in the chain of title. And so what that means is I'm affecting the exchange totally with documentation, and then the transaction is going to take place like it would in any other transaction, meaning at the sale, deed is going to go directly from my customer to their buyer, and at the acquisition, the deed is going to go directly from that seller to my customer. So no additional doc stamps, no additional title insurance costs. None of those additional costs are incurred because we get to do this direct deeding process, which is laid out in the regulation. So all of these people you see here on this list, employee, attorney, accountant, realtor, investment banker, broker, your relatives, those people can't be your QI. You need to have an independent, neutral, qualified intermediary transact the 1031 for the customer. And I mentioned previously, I would show you one quick slide so I don't keep you over. Actually, it's going to be 2. So these are the exchange types. We mentioned the reverse already. We mentioned the reverse improvement, and we mentioned the improvement, also known as a bill to suit. The 2 main types that are transacted, number 1 is the delayed exchange, and that's the timeline we mentioned. And the other is a simultaneous exchange. I mentioned with QI and without, if it's a true 2-party swap, meaning let's say Scott and I were going to exchange vacant pieces of real estate with one another, you don't necessarily need a QI to do that. That's rare. I've had it happen to me twice in all of my interactions with customers. So typically it's a simultaneous, meaning I'm going to sell to April and I'm going to buy from Scott, but those transactions are going to happen on the same day or within 24 hours of one another. That's what I call a simultaneous exchange. A delayed exchange just means, let's say I sell to April, I'm going to buy from Scott sometime in the next couple of months. So those are the typical structures that are out there. Delayed is by far the one that we use most. Simultaneous, not so much, especially because people are buying and selling in different geographic areas of the country. Because of time changes, et cetera, it's oftentimes hard to get those things organized for money to transfer via federal wire system, et cetera, to get those things closed that quickly. So this little slide here, and you're going to see items fly in. This is what every exchange transaction looks like, regardless of what we call it. It's just going to be the timing of these things flying in and out that change. But otherwise, everything happens exactly the same. So you see here, most transactions are what I call four-party. You've got the exchanger looking for tax-deferred treatment. You've got the buyer of the piece of property that they're selling. You've got the seller of the piece of property that they will acquire. And then you've got me, QI, down here, coordinate everything to make sure it's set up as an exchange. So first thing that typically happens, exchanger calls me, we talk about the deal. They say, yep, I want to proceed, set me up. And so what I'll do is prepare an exchange agreement, which is the contract between myself and that customer. And then I'll prepare an assignment document, which assigns their rights to the transaction to me, not their obligations, just their rights. And that's what allows me to tell the settlement agent what to do with closing funds. And it also allows me to instruct the settlement agent to direct deed from my client to that buyer. And so that's typically what happens. Closing occurs, asset is transferred, and the money from that disposition comes to me to put in my customer's exchange account. And then if we're doing a delayed exchange, sometime during the 45 days, they're going to ID, and then sometime before 180 days, they're going to close. I'm going to finish up the balance of my documentation. I'm going to send the cash to the closing at my client's instruction, and they're going to receive the deed to their replacement property, and their exchange is completed. So for me, it's really simple. We do this so often, it's just, for us, we don't even think about it at this point. But the luxury is it's always the same. It's just timing that changes. So it's hard to create issues in the process because it is pretty straightforward. So this is just a visualization of the timeline. Day 0 is the day that you close on your sale property or relinquish property. You have 45 days to identify what it is you might acquire. And then the balance of 135 so for that total window of 180 to actually close. And so in the identification process, how do you do that? You have to choose a rule. These are the rules on this particular slide. 3 property means you can identify up to 3 properties regardless of value. And as long as you buy something that you identified out of those 3, you're okay. The 200% rule lets you ID more than 3, but you have to be conscious of value, because that rule limits your replacement value, the total value, to 2 times the value of what you sold. So for example, if I sold for $1 million, I could identify 10 properties worth $200,000, and I would be okay because I only identified in aggregate 2 million, so that's 200% of 1 million. And then because it just happened to work out to be 10, that's okay. But you can see that's more than 3, but it satisfies my value cap, so I can use the 200% rule. That's usually used when people are diversifying. You know, Scott mentioned earlier, can I buy 3? Sure. And oftentimes, if people are doing that, it's because they're diversifying, and they will oftentimes identify even more than 3 and end up with buying 3 at the end of the day. This last one is very rarely used. I've only had it used on me twice, and the reason is that you have to buy 95% of the equity of what you identified. So my example, if I sold for $1 million, let's say I identified 10 properties that totaled $5 million. At the end of the day, I have to buy $4.5 million worth of property to satisfy that exchange transaction with my $1 million that I have sitting around. So oftentimes that's not accomplishable, and therefore people don't use that rule. In that 45 days, you have to identify in writing. You need to unambiguously describe what it is you might acquire. Usually property address is the best way to do that. You've got to deliver that writing to somebody in the transaction who's not disqualified. That's typically me, but it doesn't have to be. And you can only identify and revoke and re-identify or supplement that identification during the first 45 days. Once that 45 days comes and goes, midnight of that 45th day, you are stuck with what you identified. So I always suggest to customers, you don't have to be under contract necessarily, but you should be fairly certain that whatever it is you ID, if you're not going to be able to close on it in the first 45 days, whatever it is you ID, that you are very comfortable with the fact that you're going to be able to close on those, because the IRS doesn't care if they blow up or if something happens. You're stuck with that identified property. The only exception happens is if there's a declared disaster. And so a recent example would be in the Panhandle. And then again, it depends on where you are in the process of whether you get the advantage of the extensions. But in the Panhandle, when the hurricanes came through, some customers got to take an extended identification window. Some customers got an extended closing window, but it's particular to the area that's declared a disaster, and it can even be particular to a county. So other than that declared disaster area, and the one time we had something because of COVID, those days are etched in stone. They're typically never extended, and you have to be compliant with them to the letter. Not, for example, a lot of people, like if April 5th falls on a Saturday, you get till Monday to file your tax return. These days are calendar days. If it's on a Sunday, you better comply on the Sunday. You don't get till the following business day. So we want to make sure that we're conscious that the customer's doing that correctly. We look at their ID statements to make sure that they're on the correct path. And if we see something anomalous, we will certainly tell them and make sure that they're doing it correctly. So these little key points here on this slide is kind of what we've talked about in a nutshell. This is just really a tip of the iceberg kind of conversation we had today. There's a lot of unique and interesting things that can be done with 1031. For someone like myself, that this is all I do, even though I'm a licensed attorney, I don't represent customers in a legal capacity. I only do 1031 exchanges. The luxury, as I mentioned at the beginning, is anybody can call me, run scenarios by me, ask my opinion of what a result might be based on what they're proposing, and I will offer up my opinion. I'm not going to act as their tax or legal advisor, because that's what other professionals are for, but I will offer up my opinion. I will even provide support for that opinion to them or to their advisors to make sure that they're clear that what I'm suggesting is okay. And then the hope, again, is that if they decide to dispose and do an exchange, that they'll use me as the QI. And so, again, that's true for you, your customer, their advisors. It doesn't make a difference. Anybody that wants info, all they have to do is call me. And so with that, I'll wrap. So I know we went a few minutes over because we started a few minutes late. But if anybody has any questions, I'm happy to stay on and answer. Or if you just are more comfortable calling or emailing me with your questions, please feel free. I will respond to them. And if I can
we do
help,
have a couple of questions.
Okay, go ahead.
The first one is it true that you can rent your place 2 years before you sell and then qualify for a 1031?
So
renting your homestead, I believe. Didi, can you unmute yourself and go ahead and verify your question? Are you talking about a homestead piece of property, then renting it out for 2 years, or what are we speaking of here?
I was talking about a beach condo that we just purchased, and we're not going to rent it out. But then I had heard that if you rent it at least 2 years before you try to get a 1031, then you can qualify.
So it doesn't necessarily have to be 2 years. So you bought that, and I'm just going to make up date. You bought that yesterday. You're not going to rent it presumably, but maybe someone's going to come along and make you an offer for substantially more than you paid for it, and you decide, I'm going to sell this thing. Can I structure it as a 1031? Your only concern is, for audit purposes, is where are you in a tax timeline? So if you bought it today and you sold it tomorrow, that's a short-term gain. If you structured it as an exchange and for some reason it was disallowed, you would just have to understand that now you're paying ordinary income tax on that sale because you held it for a very short period of time. If you wanted to ensure that even if you did it and it failed, if you wanted to ensure you were getting a preferential capital gains rate treatment, you would want to own it for at least a year and a day. And then anything beyond that is not going to impact how much tax you pay. So the 2 year period that you're mentioning, I hear that bantered about by really conservative practitioners. But the reality is you get a preferential rate treatment after you own it for a year and a day. If that makes sense. So if you bought it today, you could do it at any time, in my opinion. It's just a matter if it fails, what's your overall tax obligation going to be? It'll be high if you do it in a year. In the first year, it'll be lower if you do it in a year and a day after. But you could structure it that way anytime. My opinion on investment is if I buy something today and I've expressed my intent to hold this thing for investment, and somebody comes along tomorrow and offers me a premium, I should be able to dispose of that asset, structure it as a 1031 exchange because it did exactly what I wanted. My intent was to hold it for investment purposes, either for cash flow or for appreciation. And my net result is I got appreciation. I should be able to structure it as an exchange.
Okay, so if I am getting that correct, you don't technically have to rent out a beach condo to qualify. It's just you can say you bought it as an investment because it was going to make money.
Correct.
Okay.
Income producing is not a requirement.
Great, thanks.
Thank you very much, John. Do we have any more questions from anyone? Please feel free to unmute yourself and shout out now.
I've never done a 1031 exchange, but I don't want that to prevent me from pursuing any opportunities. Would you hold my hand in the process?
We do. And I'll mention too, I mentioned our website, and I have them available on my desktop as well. But any kind of topic that we've discussed today, and virtually every other topic related to 1031, we have little snippets in the form of PDFs or publisher docs or Word docs that are specific to these types of points. And so I'll give you an example. I do all the time. I just did one this morning. A gentleman reached out to me and said, "Hey, John, I'm considering selling something in Georgia and buying something in Florida. I don't know anything about the process. Can you help me?" And what I did was quickly replied to him in an email, and I sent him links to two docs I have. One's called 9 Steps to Success, and it tells you, 9 steps in the process. And then I have another one called Just the Basics, and it kind of talks about a lot of the things that we talked about this morning. And I sent him those 2 items so he can take a look at it and educate himself a little bit. And then presumably he will follow up with whatever questions he has, and we will figure out, does it work or does it not work? And so it can be done that way. It can be done with calling and saying, "Hey, John, my customers had told me X. I immediately thought of exchange. Can you verify whether it's something that's appropriate or not?" We can have a quick discussion, and you'll know right then and there, should you continue down the path or the path doesn't make sense. So yeah, that's what we're here for. And not only me, but everybody else in the office can do that same, provide that same function.
Anyone else? Crickets. I think you've answered all the possible questions that anyone has ever had, John. Thank you very much for coming out today and hosting this and being part of this so that you can educate all these agents on just what a 1031 exchange is. I do look forward to working with each one of them now in a 1031 exchange in 2021 with your assistance as well. Again, you guys are more than welcome to reach out to any one of our offices at uspatriottitle.com to get John King's information. Yeah, he is the only one that we recommend for 1031 exchanges. He is with First American Exchange Company. Also, I have in the comments here in the chat box, I have typed his information in again. It is John King at firstam.com. His phone number is 833-323-1031. His website is www.firstexchange.com. Again, please feel free to reach out to him with any questions. He says that all the information that is inside of his head is free for you to use. You just have to ask the questions, and he will walk you through, no matter how green you are at doing a 1031, be it your first one that you've never done anything, or even just this is your first time just hearing about a 1031 here today. He will be more than happy to walk you through the process and help you in any way that he can. John, I greatly appreciate you and all of your knowledge that you have. Thank you very much for being here today.
Yeah, thanks for having me. And, just reiterate what you said. Yep, I'm here to help. Reach out. We're happy to do whatever we can.
Wonderful. If you guys also go to our website, uspatriottitle.com, you can go to our events tab. You can see all of the upcoming ones that we have. We have one coming up in January for short sales, and then we will filter all February through December and momentarily with all the other educational seminars that we have coming up. I appreciate every single one of you for being here today. If you guys have any questions or concerns, we also have 2 attorneys on staff that will help you with all of your real estate needs. They also do all of that information pro bono as well. Marika Stevens, she's in our St. John's office, and Aaron Sullivan is in our Mandra office. And both of them are real estate attorneys that can help you with your questions with contracts and writing and anything that you guys need there. I look forward to working with all of you guys in the future. Thank you very much for being here today. Have a great day.
Thanks.
And Merry Christmas.